All right, let's go and get started. Welcome to the September version, the virtual version of the Southwest Venture Forum. Good morning, everyone. My name is Simon Mack. I am the Executive Director of the Caruth Institute for Entrepreneurship at the SMU Cox School of Business. Again, it is a delight to see you all. Happy new academic year. So as you've heard in the news, there's a lot of excitement on campus around the country. And so we are doing all of our best to address all the different issues that are popping up. And so I'm so glad that you're able to join us this morning. I'm also very glad to welcome the DFW Private Equity Forum in our audience this morning. I want to note that this event is being recorded and will be posted on our YouTube channel called Cox Caruth Institute. So check us out. Check us out on YouTube at Cox Caruth Institute. That's our YouTube channel. Also, the event handout was emailed to you, so you can download this document and use that to follow along with our program. All right? So, thank you again for being here. I want to now continue with thanking our sponsors. The Southwest Venture Forum is a nonprofit program of the SMU Cox School of Business, Caruth Institute for Entrepreneurship. So we really appreciate the support of businesses in the Dallas community. So, Julianne, can you show our sponsor slide, please? All right. So today, I want to welcome and thank our gold sponsor, USI. I also want to welcome and thank our silver sponsors, Dorsey and Whitney, Mastergy, PNC Business Credit, and Riveron. Our media sponsor this morning is the Dallas Business Journal. So thank you all, USI, Dorsey and Whitney, Mastergy, PNC Business Credit, Riveron, and the Dallas Business Journal for your support of this September Southwest Venture Forum. So if you're interested in sponsoring our November event, please let us know at smu.edu/Southwest Venture Forum, SWVF. Okay, now I'd like to ask from our gold sponsor, USI, David Artsaronian, who's a Cox alum, to come up and say a few words. David, you're on.
Thanks, Simon. USI is proud to sponsor this event. Simon asked that I give a brief overview on USI. For those of you who don't know, USI is a top 5 national insurance and benefits brokerage and consulting firm. We work with middle to national market size businesses across all industries. Right now, business owners are faced with the most difficult insurance market cycle in over 2 decades, with many companies seeing significant, often unplanned cost increases on one of their largest expenses. USI gives companies a competitive edge in combating these market forces by doing the math, analytics, and analysis independent of the insurance company. Our technical consultative approach helps our clients reduce costs, improve cash flow, better protect their balance sheet, and enable more informed decisions around risk. Please feel free to reach out should you be having any challenges or if you would like a copy of our current State of the Market report. Thank you. Good morning. Appreciate it.
All right. Thank you, David, and our gold sponsor, USI. Now, I'd also like to thank the Southwest Venture Forum Program Committee members who help us create our programs like the one that we have this morning. So I want to thank Pat Hamner from Patriot Capital, John Hosgravy from Hunton Andrews Kurth, Whitney Johns Martin from TWV Capital, Philippe Mendoza from Aristos Capital, Bill Raleigh from the Texas Capital Bank, John Terry from Churchill Terry, and Hubert Zaitchik from Health Wildcatters. So these are the folks that help us put together programs. And so if you have program ideas, please feel free to contact them and we'll see if we can get it on the docket. All right. let's go ahead and get the program started with our entrepreneur presentations. All right. Our first entrepreneur is Kathleen Erickson. She's the owner and creator of the Short Game Place. So let me go ahead and put Kathy's information on the screen. All right, Kathy, you have 5 minutes to give us a presentation. I do have a timer on my end, so you'll hear the beep. That means to go ahead and wrap up. So Kathy, are you ready?
Yes, Dr. Mack, I am ready.
All right, tell us about the Short Game Place, Kathy. Go.
All right, here we go.
Kathy, you're on mute.
There we go.
There we go. All right, ready? Go ahead. Let's go.
I know there are many of you out there who love to play golf as much as I do, but maybe you didn't know how much the love of golf was growing. I am Kathleen Erickson, and I am here to tell you golf has welcomed a whole new community. So what's the problem? Golf courses are closed at night and during bad weather. Some people have to travel across the country just to play. This can all drastically reduce your skills and your desire to continue to play golf. So I decided to solve this problem for myself and for others. I designed the Short Game Place, a patent-pending golf course created to be played indoors so everyone can learn and play golf, day or night, rain or shine. The Short Game Place is a 9 or 18-hole short game course. And did I say it's indoors? When you enter each hole, you will find yourself inside that environment with the sights, sounds, and smells. The water is real, the bunkers are real, and the challenge is real. We even control the strength of the wind and the amount of light. The foliage and the turf are artificial, and you won't be able to tell because our turf plays like real grass. This is the best of outdoor golf indoors. We're open 24/7 so you can play real golf, day or night, rain or shine. Our first location houses a single 9-hole course, the Chip Shot Bar and Grill, 2 practice facilities, a PGA high-tech clinic, executive rental space, and more. You'll think of us as a 5-star golf course because we will treat you like royalty. We will constantly restructure our goals, processes, services, training, and products to make sure the final results meet our core values. This gives us the ability to make your experience worthy of your time every time you return. PGA instructors and personal body mechanics certified in our proprietary golf exercise program are trained to keep you golfing for a long time with physical ease and health. Our mobile app and back office technology are powered by Lightspeed. This mobile technology is used by golf courses around the world. Now let's take a look at our market. With the draw of sports entertainment, more people are looking to learn and play. This includes women and millennials who are looking for a faster and less expensive yet comparative alternative to joining a golf club or playing for hours outdoors. Golf product manufacturers and their sales outlets are seeing an increase in profits. Topgolf began their business wanting to be a great instructional facility, not knowing the potential opportunity they were creating in the sports entertainment world. In 2019, they became a $2.1 billion company. As a whole, the economic impact of golf is $84 billion just in the US, with $6.2 billion in Texas. The Short Game Place draws blue and white collar workers who have time constraints but have the desire to fit a game in their schedules. It also brings students, groups, and organizations who are needing a place for training on a consistent basis, not being held up because of weather. This will be a happening place. Now I'd like to show you how we will make this happen. Our first facility and world headquarters will be in the heart of Sports City, USA, Frisco, Texas, a stone's throw away from the new PGA headquarters. There are 6 stages to reach opening day. As of today, we have completed stages 1, stages 2, and stages 3. We are now looking for founding funders to begin stage 4. Once we open our first facility, prove the concept, we will begin to expand systematically around the globe. Our goal is $20 million valuation by our 5th year. To achieve this milestone, we'll open 2 to 3 facilities each year to begin, and then 10 each year to realize our global position. That's a $1 billion company by our 20th anniversary. Each location is projected to reach $5 million by year 4. We will accomplish this because of our patent pending design and our first star world-class customer experience. All this is made possible by the incredible team of professionals I've assembled. Now let's meet them. This group represents the best management and customer service skills needed to take the short game place from concept to a billion-dollar empire. Collectively, we have over 40 years of retail and big box management, and golf is in our blood. Marvin and I have managed over 20 corporate golf tournaments in the DFW area. We will hire graduates of the PGA's College of Course Management to be general managers of our future facilities. I have the vision and the ability to oversee the creation of this empire. My skills speak for themselves, and I am a leader of integrity, especially in honoring my word. Now, here is our request. Currently, our company has assets valued at over $2 million. We are looking to raise $8 million to buy, build, market, and open our first location and world headquarters. Every $1 million investor becomes a Class A member with equity percent, and Class A members also receive equity percents in our expansion company. In summing up, I feel you now understand that golf is very profitable. More people are choosing to play golf. The short game place is the solution, and all we need now is you. My name is Kathleen Erickson. I am the owner and creator of the Short Game Place, and I would like to thank you for your time today.
All right, thank you very much, Kathleen. Appreciate that. All right, now what I want to do is I want to make some brief announcements before we go into the panel discussion. All right, the first announcement is that our next Southwest Venture Forum is November the 19th. November the 19th, what just happened in November? Well, what just happened is the elections. So our topic is going to be election impact on venture financing. How about that, all right? And so we've got two outstanding speakers for our November event. Our first speaker is former mayor and Dallas businessman, Tom Leppert. The second speaker is former Dallas Fed executive vice president and current SMU Cox economist and professor, Dr. Harvey Rosenblum. So they will both share their insights on the impact of the elections on venture financing. So go to smu.edu/SWVF to sign up. Also, as an announcement, our fall starting a business certificate class will start in 2 weeks. And yes, we're going to go virtual again. So we had a great time teaching this class over the summer virtually. And so this is a class that is designed to give you a quick introduction to all things entrepreneurship and a quick introduction to basic business concepts. In addition to the lectures, we have added a new feature to our course. We've added a practicum as part of the course. And what that means is we will have a separate session where we will provide hands-on help to each student on their specific startup idea and businesses. So we're very excited to add this new feature to our course. So go to smu.edu/SAB to sign up today and check us out. All right, I'm now delighted to introduce our panel topic for this morning, which is an update on private equity. What's going on now? What's going on in the future? Before we jump in, I just want to remind everybody that on the webinar, at the bottom of the webinar, you have a Q&A box, right? Type your questions into the Q&A box, and we will allocate about 10 minutes at the end of the program to respond to your questions. All right, Pat Hamner from Patriot Capital is our moderator this morning. So Pat, I hand the video over to you. Pat.
Let's see. To start, I wanted to thank our three panelists, Marquez, Bela, Jason Apple, and Warren Bonham. You have detailed bios from them in the material that you received before we got going here. I also want to thank sponsors Gina Betts at Dorsey, Katie Marshall at PNC, Ellen Smith at Riveron, and David Hamner at Mastergy. So thank you all for helping us out here. Let's just jump on in. I want to get going here. So first off, three guys, Jason, Marquez, Warren, give us a high level on your private equity strategies at your firms. We're going to go deeper later, but just give us kind of the elevator pitch right now. And I'm going to throw up a little slide here. The top section kind of focuses on that question.
Sure.
Jason.
Good morning, everyone. Thanks for having me on the panel today. So CenterGate Capital is a $350 million lower middle market buyout fund based in Austin, Texas. We have our size and sector, it's really a lower middle market focus where we focus on businesses, call it 30 to 150 million of revenue, manufacturing, distribution, and industrial services are the core focus, but we have much more of an opportunistic investment style. So we're really looking for owner operators, family businesses. We prefer to be this first institutional capital into a deal. And we're much more focused on the situation of the business, which we'll go into later of what we're looking for. But generally, these are, small to mid-sized businesses that need a lot of help getting professionalized. And we look, as Pat has on the slide, for, financial engineering, depending on the business. If it's stable and growing and it's appropriate to get a healthy amount of leverage, we'll look for that. We always look for multiple expansion and arbitrage as a key part of our strategy, which we'll talk about more detail later. And we're generally looking for M&A, add-on acquisitions, in a buy and build strategy. So that's CenterGate in a nutshell.
Thank you. Marquez?
Thanks, Pat. Thanks for having me, and appreciate the time this morning. So I'm with Rosewood Corporation. We're a division of the corporation, which is Rosewood Private Investments. We're one of three. We have an energy group and a real estate group, and we're each owned wholly by the Caroline Hunt Trust Estate. So we are an evergreen entity. We'll talk a little bit about what that means and why that's different. But generally speaking, we're looking around the same areas as Jason is in the lower middle market. And we may hold deals longer, but we're also looking for companies in that kind of $25 to $150 million transaction range, and we seek to hold some in a shorter period of time, and some we will park as more legacy investments that we may hold for indefinitely.
Great, thank you. Warren?
All right, yeah, good morning, everybody. So I work with Insight Equity. We've been around roughly 20 years, investing out of our third equity fund right now, which is $640 million. So maybe a little bit larger in terms of focus, but not dramatically so from a size standpoint. But if I had to distill our strategy down into one sentence, I would say we're looking for strategically viable companies that have some gap between where they're performing at today and what we view their full potential as being. So won't beat that up too much more. We'll talk more about it later, but we would not even take on a project, even if it were free, if the company were not strategically viable. So we've just seen too many disasters happen from people trying to fix strategic problems. It's very difficult to do. Fixing operational problems, yeah, we think we're very good at that, and that really is what we're looking for. Again, not looking for something that is fundamentally broken, but something that's got, again, a little bit of a performance gap between today and full potential. The heritage of Insight Equity came out of the consulting world from Bain & Company. So we've developed a lot of tools, or they developed a lot of tools over time. We use those tools to try and improve companies, again, operationally, and roll up our sleeves and get our hands pretty dirty throughout the process. So that's really what we're looking for is, certainly we do financial engineering. We're looking for multiple arbitrage, but where we think we're really differentiated is trying to grow EBITDA from X today to 2X or 3X over the course of the whole period. Tend to buy companies that, and it's been covered before, that kind of make things and move things. That's really our area of focus. Could be in almost any industry, although we do avoid things that we don't understand very well or that we think are a little bit out of favor. So we won't do retail, for example, which has turned out to be good today. Good to avoid today. We don't do restaurants, we don't do real estate. There's a couple of things we don't do, but apart from that, we'll look at almost anything.
Fantastic. Thank you. So let's take a quick look, bird's eye view, state of the market. I thought it'd be interesting to look at the M&A in North America over the last, couple of decades or so, and how has this COVID crisis compared to the dot-com meltdown and then the great financial crisis. And you can see the numbers, the dollar values and deal drop roughly, between 50, 60, 70%. Number of deals actually is not down near as much in this current downturn as it was in the prior downturns. So as we sit here and look at kind of this, Warren, Jason, what's your thought about Q4? Are we going to see a pretty good rebound here in Q4 on deal count?
Well, it's been an interesting year because Q1 started off strong and only the end of Q1 was weak. The second quarter started off, as everyone saw, with a massive, decrease in deal flow and deal count. We at our firm saw a pretty material uptick in June, and then July almost hit last year's level. So we actually saw the recovery happen from a deal flow and activity level early to mid-summer, and then September has started off very strong. I think the $64,000 question, Pat, is what's going to happen in Q4. We're hearing two different stories. The first story is everyone's coming out to market post-Labor Day, as evidenced by a strong September. People are worried about the election. People are a lot worried of taxes, which we'll talk a little bit about later. And we're seeing a lot of owner-operators wanting to rush to get a deal done. So that supports a very busy Q4, but we're hearing from other side of our investment banking friends that they really want the certainty of the full year and the forecast for next year, and they may hold until Q1. So I think there's still some unknown for Q4, but September started out very strong.
Excellent. Warren, what do you think? V-shaped recovery? What's the shape of the recovery looking like?
Yeah, I think lots of different perspectives on that out there in the so-called real world, but I would say we internally are thinking more of a U-shape. We'd love to see a V-shape, but I think it's more realistic to see a U-shape. To greatly oversimplify things, obviously consumer spending kind of underlies the speed of the recovery. For consumers to really start spending again, to oversimplify, two things really have to happen. They've got to have some cash in the bank. And, that certainly has taken a hit with people, not being fully employed, although to be honest, the unemployment statistics are, to be frank, a little bit better than I would have thought they would be at this time based on what we were thinking 2 or 3 months ago. So, but it does take some time for bank accounts to recover to the point where consumers feel comfortable spending. And then they also have to feel some level of security, both physically and economically. So the economic part, I guess we've touched on, but the physical part, COVID is obviously a major impediment right now. Would love to see the silver bullet come in the form of some kind of vaccine that's effective, but counting on that happening is difficult to do. Certainly fingers crossed, and there's some positive signs, but I think it's more likely that, we'll continue tweaking and experimenting with these, the reopening or gradual reopening of certain parts of the economy. A lot of experiments underway in different states and different industries, and cautiously optimistic that's going to pick up speed over time, even, with or without a vaccine. But again, that just, I think, takes time to sort out. And, I think people who've been on airplanes, for example, haven't done a lot of that, but, I haven't felt uncomfortable. I know a number of other people are certainly getting more, more aggressive in terms of experimenting with things like that. And it appears, I haven't seen any statistics, for example, about COVID outbreaks being traced back to things like that. So, as people get more traction, more comfort, and feel more secure, I think they'll feel more willing to part with dollars in their bank account. That then will drive all the other economic activity that we're all counting on. But again, I think that just takes a little bit of time and probably portends a U-shape versus a V-shape.
Okay, good. Marquez, is this having any impact on your outlook for like holding periods on your portfolio?
Yeah, so we tend to ladder our investments because we're an evergreen entity. We like to have some exits pretty regularly and make investments with some regularity. So we had quite a few exits last year, and we exited 12 companies as part of our holdco in aerospace on January 27th, which it's better to be lucky than good, because that was a very fortuitous timing for us. We'd probably be holding that asset for a decade if we hadn't exited to KKR a couple months ago. So because of that, we've hit pause on the rest of the exits for this year because of that and the market conditions. But we are evaluating a few exits in the first half of next year, and I think the balance of those, they're all on path for for our hold period as planned.
Fantastic. Okay, thank you. So let's talk a little bit about the private equity ecosystem. Basically, it's got three legs. You got to raise money from limited partners, invest in the portfolio companies, and then exit those deals, give the money back to the LPs. If you did what you said you're going to do, the returns are where they need to be, then you get to kind of do it all over again. So what we want to focus on next is how are we doing in each of those three legs of the stool: deal activity, exit activity, fundraising. So we're going to flip through a couple of slides and just have a little discussion here about this. Marquez, I'm going to let you hit this first one on new PE activity. What's the rule of thumb out there, and how are we doing so far this year?
Well, you see in these blocks on the right that activity has definitely been down for the first 2 quarters, and we've seen that as well here at Rosewood. These drops of 35%, for example, during Q2. We didn't see that in actual deal flow necessarily, but what we typically see is that deal flow year in and year out, and going back even to the 2008 time frame is for us is within a band. But what happens is the quality of the transactions that are coming to market change somewhat. I will say that I'm encouraged by the level of deal flow that we are experiencing right now. Specifically the bids out. So our bids outstanding right now is up 30% year over year. And that's, I think, in part due to the fact that we have been on planes. I'm sitting in a hotel room right now in Louisiana. We're kicking off diligence in a new transaction. So we're trying to be greedy while others are fearful, and we're trying to take advantage of the opportunity when some of the large strategics in particular are not traveling and looking at acquisitions. We've had a couple of opportunities where deals that we've bid on in the past have come back to us and said that they were in discussions with another party who had a higher valuation, but that they wanted to re-engage with us because they felt confident that we would get on a plane, get there, and close. So our activity is very high at the moment, and we're very encouraged that we're going to have a year by the end of this year that'll be similar to the last couple of years.
We talked earlier about the importance of add-on acquisitions. Tell us a little bit about that. What's going on there?
Well, like the others on the panel have mentioned, this is an important aspect of private equity, and I think it's an increasingly important. We'll talk about some of the divergence in multiples a little bit later, but this is very important for us. I would say of the 4 new platforms that we're pursuing, 3 of those are buy and build strategies. And there are a number of reasons for that, but the valuation changes and really the asymmetry of the value drivers. In other words, something's more valuable to us because we already have a platform than it is to the seller. And that really has driven our most recent acquisition activity. And you see it on this slide. I mean, 70% is quite a number, and it continues to climb, and we've seen that for years.
Great.
Yeah, just to jump in, Pat, for a second. Just to jump in before we leave that point. We started the year probably 90% of our focus on new platforms with the deals under LOI. We're probably 50-50 now, and expect to be heavily focused from a firm strategy standpoint on at least half of our time on add-ons for the next several months.
I heard of a group in Houston that thinks they'll do 10 add-ons this year and virtually no new platforms. So yeah, definitely it's in the strike zone. So let's shift to exit activity. Warren, I'm going to let you kind of hit the highlights here. Rule of thumb.
Yeah. From an exit standpoint, obviously, if deal flow is down, part of the reason for that is people are not exiting with the same rate that they once were. But the way we think about it, we would probably separate companies into 3 different buckets. You've got your A quality assets, you've got at the other end, you've got your distressed assets, and you've got kind of a big blob in the middle that are good and sort of plodding along. The A deals and the distressed deals probably still are getting done. It's the blob in the middle that really aren't at this point. But yeah, A deals, they didn't really get hit by COVID for a variety of reasons. Multiples and whatnot are still healthy. There's still lots of cash trying to find those deals. Those deals are getting done. The distressed deals, there's a lot more of them. They have to sell. They've got to find an exit. So those deals are getting done. It's really the ones in the middle that are not, whether it's a PE-owned deal or owned by somebody else. And obviously lots of reasons for that, but they are getting hit by COVID to an extent, but lenders generally are being patient with those deals. I mean, they're not strategically broken. They're going to come back at some point. But yeah, nobody wants to sell those deals unless they really have to, unless you got a gun to your head and you've got a fund life issue, for example, or some other issue that's making you bring those deals to market, kind of letting them age a little bit more, working with them, working with your lenders, waiting until the timing is a little bit more opportune. Again, those are the deals that are going to get a little more dust on them before the exits happen. And obviously you see that in the statistics, and that certainly is the way we're viewing our portfolio. I mean, as with every portfolio, you've got some deals that are hitting on all cylinders, some you're a little nervous about, and you've got quite a few in the middle. Those ones in the middle, we might have thought of some exits for some of those, 6 to 8 months ago, but we're not too serious about thinking about exits for the middle blob at this point in time.
All right. I'm going to take you on to fundraising. 19, interesting year.
Yeah, so fundraising, again, the way we look at it, it's something that never stops. So we're always in fundraising mode, even though we're investing out of our third fund and we're not quite done. So those conversations with LPs are something that you just got to keep doing, whether it's with your current LPs. You're always having conversations with them, whether you want to or not. Sometimes you're doing it voluntarily. Sometimes they're kind of forcing those conversations, but also always having conversations with new potential sources of capital. But I would say over the last 4 or 5 months, the type of conversation has certainly transitioned. So before, they really were pushing for capital deployment, obviously doing it in a prudent manner. I would say they don't necessarily want to hear that much about that activity at this point. It's, well, at least maybe today they do, but over the last 4 or 5 months, it's been much more, how many COVID cases have you had? What are you doing to prevent COVID outbreaks in your facilities and that sort of thing? I mean, that was definitely job one. And then job two was, where are you with liquidity? Where are you with conversations with your lenders and that sort of thing? And then, kind of a distant third was, how are you reforecasting the business and that sort of thing? Those were really the 3 things that they wanted to hear about. And again, I think it's transitioning now that things kind of have, stabilized and whatnot. Now it's more about capital deployment and, putting the money to work, but doing it in a way that's, going to be value accretive instead of value destructive. But that's kind of how the conversations with LPs have gone. I would say the frequency has certainly gone up. So as they have more time on their hands, and we probably had a little more time on our hands when deal flow was lighter, you spend a lot more of that time trying to plant the seeds, certainly with current LPs, but also with future LPs. But yeah, those seeds probably don't bear fruit this year. I'd say it's much more about sort of relationship managing and grooming this year and planting seeds for 2021 and beyond.
Excellent. Jason, any thoughts you want to add?
No, I would agree with all those comments. A lot more frequency of the conversations for sure, and a lot more detailed updates during the last several months.
Yes, yeah. I know at Patriot, we built a massive matrix for each company, and we share that with our limited partners. They're far more curious today than they used to be. So, Marquez, you don't raise money; you're a family office, so I'm gonna skip you on this one, but we'll move on. So, next question is, how much capital is out there, and maybe just very very high level, where does your capital come from? So, first slide I have is the private equity dry powder slide from PitchBook. Let's see, Jason, you want to?
Yes, so I mean, you can see from the chart that there's been a steady, no matter what going on in the economy, a steady increase in private equity dry powder has been pretty widely noted. I think a lot of that is driven from the long-term, historical returns of having, beaten in private equity will beat the public markets. And there's been a lot of research, obviously. So the pensions and endowments and institutions, like this asset class. And even though there's some volatility, it's certainly not as volatile. Anyone who was looking at their daily stock portfolio in March knows that there's nowhere near the volatility in private equity. We are looking at, marking our portfolio, and not a big impact on valuations for us. We actually have about 75% of the portfolio may even hit last year's performance. So just not the same volatilities in some of the sectors in the public markets, as alluded to earlier, have been crushed. And so that nice consistency over time, I think, continues to draw, people to private equity. For CenterGate, we have traditional LPs. It's, Texas A&M, pension plans, endowments, fund to fund. And so it's a pretty traditional LP base.
Excellent. So that was on the private equity side. Strategics are also a big part of this market. You want to comment a little bit on this slide?
Well, yeah, and this data, was cut off a few years ago, but it continued upward trend. And I think the strategics were hoarding cash, up and not needing to spend up until a few years ago. And if you look at this, 1.9 plus almost 2 trillion of capital on the strategic balance sheet, the private equity, you have about 4 trillion of dry powder. And, that's really the core secret to what's driving valuations. As we get later in the presentation, you'll see some of the multiple pop, and really it's driving the equity contributions up because there's just so much liquidity out there in the marketplace right now.
Yeah, good point. Okay, let's talk about that now. Purchase price multiples, capital structure. We may do a little drill down into the debt area too, but let's get started off here. And let's see, this is Warren. I'm going to let you give us a quick intro on this slide from William Blair Merger Tracker.
Yeah, so this is some great historic data that shows over the course of a couple of cycles here. I mean, with the primary down one being 08-09, but what happens by size of deal and what happens over time. So I think in this panel, we're all focusing primarily on that top row, the less than 100 million, although maybe edging a little bit into the second row. So on average, over the course of a cycle, buying it below 10x, hopefully substantially below, but not always, but on average, buying around that 9 to 10x in a normal environment. You can see obviously went down dramatically in 08 and 09, and a little bit of a dip with in 15 and 16. Unclear this year, probably will come down a little bit more, but I think the way we look at it, obviously along a couple of dimensions in terms of adding value, and I know we touched on this earlier, part of what we're all trying to do is get the multiple up between when we enter and when we exit. You can certainly see you can do that by scaling up an asset, and we talked about buy and build and a number of different situations. So the bigger you can bulk up your company, you're going to get some multiple arbitrage, which we all love. But then buying at the right point of a cycle, so buying low and then selling high is obviously a good thing to do. So if you had bought in 08 or 09, you probably ended up doing pretty well, although I would argue that these statistics probably get a little bit overstated because in terms of the gap between low and high, we talked about in a bad economic time, it really is the distressed deals that are getting done. Those by definition get done at a lower multiple. So it kind of overweights the distressed in the low points of the cycle. The A quality assets are probably still getting done at, a little bit of a compression in the multiple, but not dramatic. I would argue it's probably more mix driven than anything in terms of what the multiples look like over the course of the cycle. So we're all trying to buy deals. I don't think any of us want the ones that have flames coming out of the building that are going for, 4x. Just strategic viability and other issues make those a little bit unattractive. We're trying to find the deals in the middle, good companies, beat up a little bit, again, no flames. But those are the deals that are harder to find because they're not as prevalent in a time like this. But that's really what we're all trying to do, is find the diamond in the rough at a time when, there's a little bit of weakness. You get a good entry multiple, you build a bigger company, you sell for a higher multiple. So
Yeah,
at
that's
high
good.
level, that's the way I would, kind of characterize that data.
Excellent. Good deal. Let's move on to, let's do actually a drill down here, Marquez, with you. This is GF data. What I like about GF data's slides, they really get down in the weeds on the small end of the scale, small and lower middle market with, you can see the 10 to 25 total enterprise value up to about 250. But what's going on this slide, Marquez, on trend?
I totally agree with Warren on the mix comment, and I think we've been seeing that year to date as well. We certainly have. We play in the smaller, probably those first two rows, more so than Insight does in the smaller deal market, and as you mentioned, the multiples are lower. And we're seeing that. I think, when we think about the multiples over the deals that got done in Q2, it really was those. It was a bit of a barbell. It was either those that were distressed that needed to do something where the stimulus capital was not sufficient, or on the other side, it was a flight to quality, and it was companies that were and that are thriving during this time. We spent a lot of time in nutrition and wellness. We own 9 companies in that space, and those have been performing relatively well during this. And we've seen a lot of add-on activity, a lot of those companies coming to market at higher multiples. So actually, while we're looking at this kind of 6 times, we're really paying north of that. We're kind of in the 7, 8.5 times range, because we, this is brought down by some of those flaming building businesses that.
All right, let's flip over to this one, and this slide is GF data where they kind of go into the premium. Is there a premium for quality deals? And their definition very quickly is a quality deal is one that has trailing 12 EBITDA and revenue growth of at least 10%. You got a management solution post-close, so management teams rolling over typically equity, and you have a private equity seller, which kind of implies that the company's been professionally, coached pretty well. Can you get more money for those kind of deals? Can we do that, Marquez?
Yeah, so we're actively seeking companies with 2 out of these 3 characteristics. We don't typically, as Jason mentioned, we try to be the first institutional capital in. So we don't typically buy from private equity firms. That's not a hard and fast rule, but I think typically that's the case. But on the other 2, absolutely. And our take right now, with some of the uncertainty that's out there in the general marketplace, is to fly to quality, is to pay up for good assets, to not lever them. We'll talk about leverage in a moment, but not to overly lever them. And then one of 3 things we believe is going to happen: either things are really there is going to be if not a V, a shorter U, and there are going to be some return to normalcy, and we'll have, good, decent assets, and we'll probably hit a single or a double with those. Or things will, stay where they are right now and uncertain for some period of time, and we'll have the scarcity value of companies that have a lot of recurring revenue and have weathered the storm well, including those in the nutrition and wellness space. Or things get remarkably better, and at that point we refinance and we take some of our equity back and really juice the IRR. So by flying to quality, we see that we're going to have more optionality given these uncertain times. And I think we're not alone in that, and that's why you're going to see these the multiples that are squared here on the slide as being significantly higher, a full turn in the case of the larger transactions.
Yeah, and Pat, I would add to that. We have 2 real-time examples where yesterday we bid on 2 new deals, both call it niche manufacturing with nice margins, nice core end markets, decent but not actually great growth. And both of them we were expecting, or we were hoping, I should say, that 7 to 8 times would have been competitive, would have gotten us at least a conversation with management. And in both cases, I got emails last night from the bankers that said you have to be a 10x or higher. And that was a slap in the face, I will be honest, and made me feel like a time machine that I'd walked back 12 months ago.
It's probably a pretty good sign the recovery is imminent. Then the last point, Marquez, perhaps to scale the scaling up from the 10 to 25 up to the 100 to 250, 4.9 times multiple expansion. That sort of drives the add-on acquisition strategy, doesn't it?
Yeah, and and I think a lot of us have been following that path over the last few years, and so there's been some scarcity value in the platforms, and it's really forced us into a little bit of a modified platform and add-on strategy where, in some cases, we'll have a thesis and we'll say, you know what, this isn't platform worthy, but this is the first company that's in this industry, and so we'll do an add-on first if we need to, and we'll park it. And we'll contribute it to a holdco and then get the scale with some, limited level in some cases of actual organizational, coalescence there. Sometimes those will they'll fold up under a holdco, which is what we've done, what we did in aerospace, for example. And we realized many multiple turns of expansion when we exited.
Excellent. That. All right. I'm just going to hit this lightly. Debt has typically been what they call a 3x4 box. 3 times senior debt, 1 turn of sub debt. So you're at 4 turns. What we're seeing, I think, out here is maybe 3x4 is now 2.5 by 3.5 in some sectors. In other places, if the sector's hot, it's probably still up at 3x4 and maybe even higher than 4. There's some where I'm seeing deals at 4.5 to even 5. But we're going to come back to debt in a few minutes in another slide. I'm going to move us ahead. Industry sectors, what's hot, what's not. You can see 17, pretty much everything was up. It's been a bit of a mixed bag since then. So maybe each of you could comment very, very briefly on what's hot, what's not for you among these sectors, or maybe something else. And I know you've touched it a little bit already, but let's hit that. Jason?
Sure. Well, I mean, we have a focus on kind of value-added distribution, outsourced industrial services, and niche manufacturing. And so we continue to see opportunities there. I would echo one of the other panel's comments about quality is down, I think, across sectors where there are some businesses that just do not feel like they have a lot of options and are concerned about the future and are coming to market. But we're seeing kind of good activity, as someone else said, across all the sectors at the moment.
Yep. Warren?
Yeah, so touched on it earlier, and yeah, very similar to Jason, but yeah, we're typically focused on manufacturing and distribution, companies that make things and move things. So that would be our area of focus. But I'd say underlying that, what we're really looking for are some themes and companies that hit on a couple of themes that we think are durable over the long term. So certainly one of them is reshoring. So, I mean, all the uncertainty with our trade relationships, what's going to go on with China, et cetera, it feels like there's going to be a long-term emphasis on getting jobs back to North America, and we'd like to be the beneficiary of that. So we're kind of looking for trends like that, or the Amazonification, if that's a word, people moving away from kind of bricks and mortar to more other forms of getting products from manufacturers to consumers. And then maybe some demographic shifts. So we certainly are aging as a population. We're the only growth really is probably going to come from immigration. That's going to drive some effects that are going to have impacts on manufacturing and distribution. So we're looking for opportunities in those couple of buckets that really check the boxes on these long-term trends.
Great. Marquez, you want to add?
Pat, you did mention earlier that I actually office with all my LPs, and so we really, when I came on board about 8 years ago, we did an internal consulting project, and we figured out what everybody had, what the group had been investing in over the prior 80 years, and a lot of it was manufacturing. So we continued that. It's tangible. I can take my shareholders out, and they can kick the equipment. So we have very many manufacturing assets historically. But the pendulum swung back, and of the deals that we're pursuing right now, quite a few of them are in services. So we're doing a little bit of portfolio rebalancing. So those are the 2 main areas. And then we just staffed up and brought in a couple new kind of mid-level professionals that have backgrounds in other areas that we're not as strong in, such as healthcare services. So we're cautiously wading into some of those new waters.
Excellent. Okay, thank you. So returns, we're accountable to our LPs to make money. Let's look at a couple of things here. I'm going to take this chart. This is put out by PNC Mezzanine Capital. And basically it shows kind of the history of sort of mezzanine debt targeted IRRs going back to the 90s, kind of started out in the mid 20s, dropped down to 19, you know, then it's you know, kind of stuck around 16.5% overall mezzanine IRRs. And then average buyout equity targeted IRRs started out, I would have said 35%, you know, when the industry kind of got rolling, got down in the 20s for a while, and now it's actually below 20% as well, down to about 17%. So not much of a spread there between mezz returns and equity returns. I was showing this slide to a private equity guy in Colorado a couple of years ago off the 17 numbers, and showing him the 17.5% there in 17, and he said, "Pat, I don't even think we're making 17.5%. I said, "Wow, that's an interesting statement. Why would you say that?" That leads us into this slide. Now, there's a lot of data on here. Don't worry. I'm going to cut to the chase. What this is, I call this the fear greed meter, and what I focused on is the percent equity. This third line down here, percent equity of the capital stack. And if you got greed going on, that's a low number, say 39%. That by 2009 was 59%. And what we saw happen there was multiples drop from nearly 10 times to 7.5 times over that period. So then going back into 13, we sort of hit 10, 12, 10, 11, 12, and then boom, first half of 20, we're at 14, all-time high there. But look at the equity. We dropped from, we went from 40 up to 60, and then 42, 46, 47, 50, 49. People are getting more and more nervous, and boom, we're at 62 right now. So fear is up there. We're doing deals at crazy, seemingly crazy multiples. And that's because these are the bigger deals. This is all U.S. private equity, not just the small end, but it's all deals. So you're doing deals without a whole lot of a safety net below you. You haven't put a lot of equity in, and the concern is what's going to happen here. And if you go back and look at 06 to 09, what did happen when things slowed down, the multiples dropped. The equity in the capital stack actually stayed about, it actually increased a little bit from 3.7 to 4.4. But what happened was 6 turns of debt went to 3 turns of debt. The credit markets got spooked. They dried up. So coming off of this peak, we'll have to see where that goes. But anybody want to comment on, you know, what could possibly go wrong here? I guess maybe that's the question.
We're heavy equity, so we always have been. So we'll take a few IRR points off, and so we can sleep at night. And so that's been pretty consistent for us.
Yeah, I agree. Heavy equity. We're seeing a lot more equity too in the deals that are getting done. So that's kind of what's happening there. The actual returns, if you want the numbers, growth equity buyouts, sort of in the low to mid teens now. 1.4, 1.5 on the returns. Are you seeing these kind of numbers, guys? But you're all above them, I'm sure, right? You're up in the 20s.
We're targeting. I mean, we're targeting much higher than that, Pat. Much higher.
Of course, yes. All right, let's keep going. Mezz is about 11, 1, and 2. So 11% base rate, 1% PIK, and then 2% fee at closing. And this is really the last slide. Again, a huge eye chart here, and we're going to make these slides available to the audience. But let's see, who wants to comment on this one? It's not the totally last slide. Marquez, did you want to comment a little bit on the delta between February of this year, but pre-COVID, and where we are today, July, August, September?
Yeah, I think the main takeaway, Pat, from this slide is that it's relatively unchanged. We saw a very quiet period there for a while. We closed a new acquisition, all equity, that we're going to refinance. In the next couple quarters, we actually got some pricing concessions from the seller by doing that and taking the risk out of it. But we're in the market right now for a unitranche, and it's kind of right in the middle of where these numbers are. Because we're doing smaller deals, and the unitranche guys are coming into that market and being pretty aggressive. But overall, I think as the lenders are coming back in, they're coming back in at levels that are, pre-pandemic.
Yeah, yeah, okay. The equity seems to be up a bit. That's the one key thing that really has changed.
Yeah, that's a great point. Yeah, so as you see in the bottom of this chart, 40% equity going to 50%. So they are, I think generally those that we're speaking with are supportive of our high equity approach.
Okay. I'm going to skip down. We've kind of hit this already on sourcing deals and qualities that you look at. Let's talk a little bit more about your diligence and underwriting processes very, very quickly, because I want to get to the next slide, which is on value creation. But in this diligence and underwriting in COVID, how has that changed? What's going on with diligence? Jason?
Sure. Well, I mean, the first, we're doing diligence now on multiple platforms and add-ons, and we've really heavily moved to remote. I think Marquez is traveling. We have not taken that approach. We've been able to do the vast majority of the diligence virtually, and we're in a mindset now where if we get to exclusivity, we're happy to meet, travel, visit the company. But early in the processes, just given where we are with COVID currently, we are not doing much travel to be one of 6 or 8 or 10 buyers to go kick the tires on a business. I'm not suggesting that the other funds are in those broad processes and maybe more targeted. So we are finding, though, it's interesting, quality of earnings, customer, a lot of the due diligence you don't need to be on site for, and it's transitioned very seamlessly, and we've been pretty happy. The fundamental business underwriting hasn't changed. There's a lot of our focus is on the customer relationships, the customer concentration, the contracts, and I would say the number one point, not that it wasn't important before, is on visibility, backlog, and how much confidence does the management team really have in their next 6 and 12 months? Because what we're seeing is that uncertainty under COVID is much, much higher. And so it really impacts how we're structuring deals. So I would say in 2020, under COVID, we've had more deals that have introduced the concept of a seller note or a seller note backstop if we don't hit the market level of debt, or maybe what the expectations were back from January, February, March. And we've had more introduction of earnouts, which everyone knows is very hard to structure and put the legal docs together. But it's been very important to try and bridge that value gap that we've noticed, because we're not stretching as high as equity as some of our brethren. So that's our overview.
Cool. I'm going to move on to the value creation strategy. Warren, tell us a little bit about your value. I know you're all about that. When does that actually start in terms of when the deal gets done and so forth?
Yeah, I would say we think that's probably our key point of differentiation. I know everyone says that, we think we believe it, but we're really looking for opportunities. I think Jason touched on it. We haven't changed our underwriting criteria. We're still shooting for some pretty lofty returns in a much more competitive environment. So obviously you've got to do something pretty transformational to an asset to be able to hit those lofty return expectations. So we spent a lot of time obviously trying to develop our value creation plan. It starts the minute you get a SIM or the first time you get a teaser even. So for us, a lot of it is, trying to think of unique angles that other folks aren't thinking about. That's the only way to create massive, return upside. If an idea is obvious, everyone is going to think of it. It's going to be priced in, and as a result, your multiple is going to come down. So it's all about trying to find that unique angle, which is not always possible. It's not always easy, but if it's not there, it's probably not an asset for us, because we're not going to be able to hit those return thresholds. So it usually is, you can have probably, like 100 little singles you're trying to hit in terms of value creation ideas. That's a really hard way to get high value creation. It typically is more about 1 or 2 big ideas that are very transformational in nature. That's really what we're always trying to look for, is trying to have that kind of 1 or 2 home run ideas. Those always come with more risk. A lot of times it comes with a lot more capital that has to be introduced into the business post-acquisition. So a lot of times it's, add-ons for sure, and we've talked a lot about that, but a lot of times it can also be some major new, new facility or new major CapEx idea to rip a bunch of cost out or to completely automate some processes. lot of different examples, but that's really what we're always trying to shoot for.
Marquez, can you chime in on that?
I totally agree. We look for opportunities where companies have been underfunded and where we can inject additional capital, whether it's a greenfield plant or whether it's automation, as Warren mentioned. And then we also try to introduce some really high-level management. Once we have 2 or 3 small companies, we put in a chief commercialization officer, chief innovation officer over a handful of our businesses, where they could go in and really help the founders, cross-pollinate and generate some revenue and cost synergies. So just upgrading the general level of management once we get to a certain scale has proven a really good.
Jason, anything to add?
We have a VP kind of operational guru on the payroll, and we parachute him into all of the portfolio companies. We spend a lot of time on dashboards, financial reporting, and really going deep into where the company's making their money with different customers. We bought a value-added distribution business in the apparel space 3 years ago, and they had no idea where they were making their money. Their largest customers were their least profitable. So we spent a lot of time in kind of those granular details and really try and get the IT and financial reporting more transparent and more actionable so we can make better, strategic decisions.
Excellent point. Excellent point. Okay, last question. Kind of, the quick round here. What's your outlook for the private equity industry? Jason?
Sure. Well, I mean, overall, we still feel very positive from the standpoint that there are a lot of folks that have not sold their business from the last recession or downturn in 2008. They're certainly not any younger, and we're seeing more and more of these private sellers realizing that exiting sooner rather than later is very beneficial for them, more willing to be open to discussions and prep their companies for sale. The investment bankers certainly seem to have a positive outlook, so they always have a positive outlook for the next 12 months. And so we still feel there's going to be a good number of opportunities, still a lot of businesses that have not been private equity held, although that obviously portfolio number of held assets has been growing the last 5 years. And we still think it's, pretty positive. And if you take the lower middle market and a lot of the hands-on operational strategies that the other panelists take, you can still get good, outsized returns. So we're still positive, although there's certainly going to be some uncertainty in the next few months.
Indeed. Marquez?
I think there are a handful of trends that are going to continue. One is the consolidation in the mega funds, who are really looking more like the bulge bracket investment banks at this point. Secondly is this proliferation of independent sponsors. As a lot of talented investors have gone out on their own, which has its own implications for value as well as competitiveness. And then thirdly, a lot of groups like ours. I like to think that we were pioneers, but every year we're seeing more and more family offices of scale directly investing.
Yep. Warren, wrap us up here.
Yeah, big tall order here, but so I think as Jason pointed out, there will definitely be some growth in the supply of companies that are applicable to the panelists here. So yeah, cautiously optimistic that's going to keep growing. It's not going to be double-digit growth, but at least some growth on the supply side. Unfortunately, there's also going to be there has historically been an explosion of capital trying to find those deals. So a lot more people who look like the panelists here this year than there were 5 years or 10 years ago. So that's greatly outgrown the supply of companies. So that's not a very favorable trend. On the flip side, I think this COVID experience may shake some of that out. So cautiously optimistic that, some of the huge disparity in terms of the level of performance at the GP level. So some guys are hitting it out of the park. Again, kind of a big blob in the middle, and then some people who probably are not going to get funded next time around. So one of the few potential positive outcomes of COVID is it probably will have some kind of a shakeout on, again, people who look like us, and maybe there won't be as much capital chasing the scarce supply of deals going forward. So always trying to look for a silver lining, and I'm hoping that's what, one of the outcomes of this situation.
All right. Thank you so much. Audience, there's a slide. This slide deck will be available. There's some further slides down with some, more comments about stuff. But this will be available on our website. Julianne will get that put up. Simon, I think you may have some last questions that came in from the audience. I'll turn it over to you.
All right. So, wow, Pat, that was a lot of information. And if you like information, you got it. You got your money's worth. Again, this event is being recorded, and we will post it on our YouTube channel, Cox Carruth Institute, so you can watch the whole thing once, twice, 3 times, as many times as you want. So there you go.
We got one my start. Okay, just edit out my faux pas at the start.
All right, so I gotta ask this question: SPAC. What is it, and what is going on in the world of SPAC?
SPAC, Special Purpose Acquisition Corp.
Yes, sir.
Okay.
We've seen a handful. We've been visited by a handful of folks who have created SPACs who have been targeting some of our assets and want to roll them in. I think it's very difficult to do. The obvious arbitrage between private and public markets is the goal there, I believe, and some are, but the problem is you have a lot of leakage, meaning that there are multiple levels of kind of promote and carry by the time it's all said and done. And we've determined that we do not want to exit to a SPAC because of the uncertainty of close. So that's my opinion on it.
Yeah, we've had a similar perspective, although obviously they're getting done this year, and that's a pseudo way to do an IPO, and there's been a number of them this year, so people are doing them. But yeah, we've looked at a couple of exits to SPACs. There's just always too much uncertainty. You strike a deal with the sponsor of the SPAC. It's got to go to a vote of the shareholders. There's so much uncertainty in terms of whether you get the outcome you want or not. We've always shied away from it. And then we've kind of looked at potentially doing one in the past, but boy, it's a finite life. So you've got the gun to your head you deploy that capital or else it's gone, and you're putting hard dollars into it, and you can kind of flush that down the toilet if you don't get a deal done. So both as a buyer and as a seller, we've evaluated it. We haven't found it to be particularly, or didn't suit our needs, but obviously other people are doing them.
All right, how about one more question about the geographic distribution of your investments? Are you Texas, US? Do you do anything overseas? Can you talk a little bit about the geographic distribution of your investments?
Sure, I can jump in with that one. So we don't have anything in Texas. We'd love to own a business in Texas with our headquarters in Austin, but right now we have 2 companies on the West Coast, 1 in the Midwest and 1 in Florida. So we are geographically agnostic. As I said way back at the beginning, we're much more kind of size and situation focused versus a specific sector. So we think you can find good businesses at every region of the country, and we don't let geography kind of limit our pursuits of new opportunities.
We're also coast to coast, but if you do look at our portfolio, it's a little more heavily weighted toward Texas, and I think that's just in part due to us being able to break a tie, given that our brand is a little better known here in this region.
You touched on international, so yeah, I'll comment on that because we look pretty much the same as the other 2 gentlemen domestically. So we avoid international exposure from a headquarters standpoint. So the headquarters have to be in North America, the bulk of the operations here. We don't mind having a plant here or there around the globe, but if you have to hop on an airplane, I mean, assuming you can ever get on an airplane again, but if you have to be able to get to your assets quickly, you can't do that if the bulk of the operations in Indonesia or China or whatever. So we like to have the bulk of things here, but could be almost anywhere.
Yep. All right. Well, I think to maintain our time, which is we try to wrap up around 9 o'clock, I just want to thank everybody. I want to thank the panel. I want to thank Patrick Hamner from Patriot Capital. I want to thank Marquez Bela from Rosewood Private Investments, Jason Apple from CenterGate Capital, and Warren Bonham from Insight Capital. So thank you very much for spending time out to be with us this morning. I also want to thank our sponsors, our gold sponsor, USI, our silver sponsors, Dorsey and Whitney, Mastergy, PNC Business Credit, Riveron, and the Dallas Business Journal. I also want to thank the DFW Private Equity Forum. So I hope the members enjoyed this event and come back for more. I also want to thank our SMU supporting staff, James Stewart with SMU Marketing, Nancy Hong, Julianne Deering from the Entrepreneurship Center, and then Pat Kriska for all helping us out. And then finally, I want to thank you, the attendees. I will see you on November the 19th, where we're going to talk about the election. We're going to talk about the impact of the election on venture financing with Tom Leppert and Professor Harvin Rosenblum. So thank you again for being here, everybody. Be safe. I'll see you in November. Take care. Bye, everybody.